The biggest risk to the global economy was never inflation. It wasn't rising interest rates. It wasn't even a banking crisis. People want to blame the Fed, or China, or oil prices. Those are loud. Those are obvious. Those are the things that get headlines and hot takes. But the thing that actually tips economies into recession is quieter. It's a slowdown in something so boring, so mundane, that most people scroll right past it when they see it. And that's exactly why nobody's paying attention. Have you been wondering why your mortgage payment feels heavier every month, even though rates supposedly peaked? Why your investments have gone sideways? Why your company is quietly freezing hiring while everyone pretends the economy is fine? The answer doesn't start on Wall Street. It starts in the credit market, specifically in a corner of it called private lending. Go back to 2008. The financial system didn't just lose money, it lost trust. Banks stopped lending to each other overnight. The credit markets froze like a river in January. So the Fed did what central banks do. They slashed rates to zero. And when that wasn't enough, they printed money, trillions of it, buying up government bonds and mortgage securities to push cheap cash through the veins of the economy.
It worked. Corporations borrowed cheaply. Real estate recovered. Stock markets hit record highs. A whole generation of investors grew up in an era where cheap money was just the weather. The system built to cope with one crisis quietly became a dependency. And then, in 2022, the weather changed.
Meet Marcus. Marcus runs a mid-sized logistics company. Nothing glamorous, about 400 employees, warehouses in 3 states. In 2021, Marcus borrowed $40 million from a private credit fund to expand. The interest rate was floating, meaning it moved with the market. At the time, that rate was around 5%. Manageable. He modeled it out. The numbers worked. Then, rates went to 9%, then 10%. His interest payments nearly doubled. He's not going bankrupt yet, but he's not hiring, he's not expanding, he's not buying new trucks. He is frozen. Multiply Marcus by about 20,000 companies across the US alone, all with floating rate private debt, all quietly frozen, all waiting. And that's called the private credit maturity wall. At its peak, analysts estimated over $1.7 trillion in floating rate private debt is set to reprice or mature by 2026.
Here's where it broke. Not dramatically, not in one headline, quietly. In Q3 2023, default rates on leveraged loans, the public cousin of private credit, rose to 3.8%, their highest level since the pandemic. By early 2024, private credit default estimates from Moody's put the distressed debt ratio at nearly 7% of the market. The stock market shrugged. The news cycle moved on to AI and elections. But in the credit markets, something was tightening. Lending standards jumped. New loan issuances slowed sharply. Companies that needed to refinance simply couldn't. And this was the beginning of the end for the cheap money era business model that had quietly kept the economy afloat for a decade. When credit tightens, the first thing that breaks is the bond market. Corporate bond spreads, the extra yield investors demand to hold company debt instead of safe government bonds, start widening. Wider spreads mean companies pay more to borrow, which means fewer companies borrow, which means less investment, less hiring, less growth. When credit conditions tighten abruptly, the historical pattern is unambiguous. GDP growth follows with a 6 to 12-month lag. But it doesn't stop there.
Move to stock valuations. Stocks are priced on future earnings. When the cost of debt rises for companies, their margins compress. They earn less. Their stock prices, theoretically, should fall to reflect that. The lag between credit stress and equity repricing is typically 8 to 14 months. That lag is why markets can look fine, even when the plumbing is cracking. But it doesn't stop there. When corporate credit seizes, it pulls mortgage rates up with it.
Not because the Fed raises rates further, but because risk appetite falls and mortgage-backed securities demand higher yields to attract buyers. That means your mortgage rate stays elevated even after the Fed cuts. It means housing stays frozen. And when housing freezes, construction slows, consumer spending slows, and the jobs tied to all of that begin to quietly disappear. There's a reason traditional media ignores this. Private credit is not photogenic. There's no dramatic moment, no Lehman Brothers moment, no single day you can point to and say, that's when it happened. It's easier to sell you a story about inflation or tariffs or tech stocks. Those stories have villains you can picture. This one has a spreadsheet.
But recessions are almost never caused by the things everyone is arguing about. They're caused by the slow unraveling of assumptions that nobody thought to question. The real threats aren't the loud ones. They're hiding in plain sight. If you want to understand finance the way it actually works, not the way it gets explained on TV, subscribe, because we're just getting started.